Greetings, it's time for another monetary creation report. This time for July of 2022, the most recent month. So as always, we go to this Yardeni report, the URL for which will be in the description box below, and we scroll down. So look at these four lines. These are the four major central banks of the world. Blue is the European Central Bank, red is the US Federal Reserve, green is the Bank of Japan, and orange is the People's Bank of China. And the US is only about 1/4 of the total amount of money printing. For the longest time, it wasn't even the largest of the four and still isn't, although might be barely once the blue line dips below the red line. So when you hear people screeching in the media about how the Federal Reserve has printed so much money and there's going to cause inflation in worldwide price commodities like gold, that is absurd. The Federal Reserve is not even the largest money printer and only 25% of the world's total. These four central banks comprise maybe 90% of the money printing done in the world. Not even a full 100%, but since these four are the biggest four, they're the ones that matter for the purposes of this chart. So only the grand total matters because technology is borderless, as we know, and the money printing in one country spills into other countries and vice versa for that specific reason. So we scroll down to the grand total. This is the all-important chart that is a summation of the four central banks we saw above. And as you can see, this is rising in an exponential trend. Every time they have decided to stop money printing, they have been forced to revert back to the trend line because technological deflation is exponential, and the economists of the world are unable to grasp that, which is why they always keep trying to undo their money printing, assuming they can even go back over here. They consider reversal of all of this to be a normalization of policy. You can't reverse $28.8 trillion of money printing. It has to be exponential and rising because technology is exponential, and this causes gross inflation that offsets technological deflation to keep net inflation in the optimal zone. But unfortunately, they are unwinding the recent QE that they have done, and they've already unwound about 3 trillion of it. So just to get back to the trend line, in about a year, they would have to do 7 or 8 trillion, which is not the path that they're even on. So this always causes a predictable script to unfold, which is that the stock market crashes, the economy teeters on the brink of recession, and the central banks of the world are forced to print more than ever before, but they are never able to figure out why they keep having to print more and more. When it's very, very obvious when you consider technology and the deflationary effect of technology. And I've been trying to build awareness of this for many, many years. Hopefully awareness is slowly growing. But they are unwinding, and they're unwinding pretty fast. Now, what is the year-over-year growth rate of this chart? Because I have said that 16 to 24% is the cruise control growth rate speed per year. So the annual growth rate should have a gradient of 16 to 24%. So let's see what it is. This chart is the same one as above, except the percentage year-over-year growth rate. Before 2018, and certainly before COVID, it was in this band, and only barely getting into the 16 to 24% band, which is what I would consider optimal. And they often would go below that because by just getting into that band, they want to preempt inflation that never arises, and they don't print enough. And they actually tried to tighten, which caused a major stock market crash. Then COVID-19 occurred and they had to print much more. And the growth rate in February of 2021, so a year and a half ago, was an incredible 46% a year. That's a level at which even I thought there would be inflation, but there was no inflation at that time. Whatever little inflation is happening now is because of obstruction of domestic oil and natural gas production. It's not because of quantitative easing, because it's not synchronized to the time of quantitative easing. And as we saw, world money printing, world quantitative easing has been going on for 11 years before 2021. So the fact that there's inflation now cannot be blamed on that at all. People have trouble accommodating these contradictory facts in their mind because it doesn't fit the narrative. So plus 46% year-over-year growth. And then they started to tighten, and now the tightening that they're doing puts them at minus 4.2% growth. This is a very, very severe tightening. Only once did it even go negative to such an extent, and we're about to break that. This almost certainly will cause a stock market correction, which then leads to recessionary type characteristics that could happen very soon. They should not be tightening at all. They should be in the 16 to 24% band. Fine, they had to overshoot for a short while. However, this gradient is steep enough that by just pausing rather than tightening, they would have gotten back to an average of 16 to 24%. But now they're at minus 4.2%. Just to go from minus 4.2 back to 16 would, again, as we saw a few minutes ago, require trillions of dollars of new money printing. Also a different type of money printing, because this buying of mortgage-backed securities and treasuries, at least in the US, is very, very saturated. You can't inject all the needed liquidity into the market to offset technological deflation just by buying two instruments. Europe and Japan and China all buy much more than just two instruments, but the United States is further behind than those other three in terms of their thought. So this is the percentage year-over-year growth rate, which I believe has to revert back into the 16 to 24% band, which it only usually gets to the bottom of, but at least getting to the bottom of that band is much better than being far below. And then we scroll further down to this chart, which is very important. All of these people screaming about how the Federal Reserve has printed too much money, they act as though the United States is the only country in the world. That is absurd. The United States is the joint lowest of the four major central banks in terms of money printing as a percentage of total GDP. The United States and China are both at about 35%. Europe, the people who are supposedly the most afraid of hyperinflation, has done twice as much. They're at 67.4%. So Europe has done twice as much money printing relative to the size of their economy as the US. The ECB presides over the entire Eurozone, the entire collection of countries that uses the euro, so that includes Germany, France, Italy, etc. But the biggest of all is Japan. It has done 4 times as much money printing as the US in proportion to the size of its economy. They're at 134.9%, and nobody claims Japan has high inflation. The net worth of Japanese people is rising very quickly, but they don't have inflation in their economy because they have called the bluff of this inflation narrative. Unfortunately, the United States is too immersed in this type of inflation scaremongering and tremendous misrepresentation of how much inflation there is versus is not, as we'll see later in this video, to even recognize that, hey, there are countries that have done 4 times as much money printing as the US without inflation. Now, another reason for this is because, as I said earlier, all money printing is worldwide. So if Japan prints this much, some that goes into the US because these things are borderless, just because technology is borderless. That's why Federal Reserve tightening doesn't really change the global picture all that much. Only the tightening of all of these central banks in combination should be measured, and that's what I always do in each of these videos. So now we go to my prediction scorecard of quantitative easing relative to what the PhD economists say. So the prediction of monetary creation in the 2020s. PhD economists still think all quantitative easing is going to be reversed. So the first 23 trillion out of that chart we saw is what they expect to be reversed in this decade. So their prediction was effectively negative 23 trillion of money printing, money tightening to the tune of $23 trillion. Whereas I said it's 50 to 100 trillion of new money printing needed just to keep up with exponential technology and the deflation that that exponential technology generates. 50 trillion if it's cash, which is what it should be, because that is the only way to diffuse it more fairly rather than buying treasuries and mortgage-backed securities. 100 trillion if they continue with treasuries and mortgage-backed securities. But it's looking like that is going to cause the system to break to a substantial degree because they're channeling all their money printing through just 2 instruments, distorting the treasury market and the mortgage market to an extreme degree, and that does not cause the more diffuse circulation that is needed. That is effectively like trying to fill a bucket with water by keeping the bucket 6 feet away from a sink and then overflowing the sink until the water from the sink is spilling onto the ground. That is what these PhD economists are trying to do, because they still cannot accept that money printing has to be permanent and exponential. So whose prediction is turning out to be right? As of August 18th, 2022, which is today, we're a little over 1/4 of the way through this decade. 2 years and 7.5 months in, and what has been done so far is plus 8.8 trillion. So if their goal was minus 23 trillion, it's not going in that direction at all. It's going in the direction of what I'm saying. And remember, this is exponential. In 1/4 of the time frame, you wouldn't expect 1/4 of the money to be done. You'd expect much more to be done in the latter stages of this window of time because of the exponential nature. But things are definitely going in the direction that I'm saying, even though they have already tightened quite a bit already. This number used to be well above 10 trillion, as you can see from earlier videos from earlier months. It's still 8.8 trillion, and I believe the markets will force them to stop tightening and to print anew relatively soon. So how is inflation shaking out? For that, we go to my inflation scorecard. So as always, we go to my scorecard, which indicates a detailed and multidimensional and international, a worldwide measurement of inflation. You can't just look at the US CPI because that is just one country. Plus, people say the US CPI is rigged. It's not rigged, but people say it's rigged, and we can prove that that is wrong by looking at indices of things that are freely traded. The Goldman Sachs Commodity Index comprises of commodities like oil, natural gas, and gold, and priced worldwide, so it's completely unriggable. The same with the yield of the U.S. Treasury bond. Yes, the Federal Reserve buys U.S. Treasuries, but the yield is something that is determined by the market, and it's pretty volatile. And I want all three of these to be at 3% on a 10-year compounded annual growth rate basis. We don't look at short-term noise because that enables people to greatly misrepresent the data by persisting on the narrative. Yes, 1-year inflation rates are high, but the 10-year inflation rate is what has to be looked at, because when there are periods of unusually low inflation, the people who scream about high inflation are simply nowhere to be found. So first we go to the US CPI. So this is the BLS.gov website, and this is the total CPI index. So to see the 10-year compound annual growth rate, what we would normally do is just take readings that are 10 years apart. So 295 divided by 230. 295 divided by 230, 1.282. So 28% inflation over a 10-year period. What is that annualized to a compound annual growth rate? We take the 10th root of that. That's how you get the average annual growth rate over 10 years if 10 years involve 28% growth. And we get to 1.025. So 2.5% growth over 10 years. Yes, sometimes it's much higher than 2.5%, sometimes it's much lower, but that is the average. Now here's what is happening in terms of moderation. The 1 month number, which is far too granular and has a lot of noise and should not be taken all that seriously, is now 0.0, even though the prior 2 months were high. But then again, April was low, 0.3. So there's a lot of volatility here. When a particular month is high, there's an exaggeration of the narrative around that high inflation. When a particular month is low, then you have competing narratives, but nobody looks at the data in an unemotional, dispassionate way, and you have to come to a place like this and look at the real data from the BLS.gov website to see what's going on. So 0.0. Now, people who say that a 10-year annual growth rate is too long a period to look at, well, the same people, why do they say 1 month is too short a period to look at? They only want to choose a window that shows high inflation because they're not actually interested in the facts. But the 2-month moving average is also moderating, as we can see over here. The 3-month moving average is moderating somewhat. We have 6-month over here and 1 year. Yes, the 1-year CPI inflation rate is about 8.5% higher than a year ago, but in 2020 it was zero. It was almost going into deflation. In 2015, also, it was zero, going into deflation. The average is 2.5%, and that is not high. It's below the 3% threshold that I speak about. So people who scream about how it was 8.5% higher than last year, well, what about the prior 9 years? And they're using this to claim that quantitative easing causes inflation when it doesn't, because quantitative easing started in 2010. Why is inflation only showing up in 2021? The reason inflation is showing up in 2021 is because the U.S. has deliberately obstructed domestic oil and natural gas production. That caused the price of oil and natural gas to rise by a huge amount, and that is the reason for current inflation. Why was this low before 2021? If quantitative easing was done for another 11 years before 2021. So a lot of people just can't process two variables at once, and this will fall just as quickly as it rose unless the US government deliberately keeps doing things like obstructing oil and natural gas production. But this is the US CPI. Now we go to the Goldman Sachs Commodity Index. Next, we're here at the Goldman Sachs Commodity Index, and the 10-year compound annual growth rate, which you can see I've clicked the 10-year tab, is actually negative, minus 0.03%. It's actually veering into deflation. It's close enough to zero that it could be called zero, but technically it's in deflation. So what inflation? What are we talking about? Oil prices are at $90 a barrel, which is lower than it was in 2012. Gold is also at the same price as 10 years ago. There's no more commodity inflation. Technology has superseded the concept of commodity price inflation. We had this little spike in oil prices, but market forces, both substitution and supply increase, have come to the rescue despite the mismanagement that caused the oil price rise that we have seen. That is directly because of a stoppage of U.S. domestic oil and natural gas production, as well as additional negative forces by Russia's invasion of Ukraine. But the technonomic medium of the world now is much more powerful than it was in 1974 or 1981 when we had prior oil spikes, and these mitigations happen very fast now. Goldman Sachs Commodity Index is the most comprehensive metric of all in terms of truly judging what is happening with inflation, and there's no net inflation over 10 years. Remind people of that when they start talking about inflation. Lastly, we go to the 10-year U.S. Treasury yield. 10-year U.S. Treasury yield, 2.88%. For a few years, it was actually low. This is a 5-year chart, and it went as low as 0.58%, but now that the Federal Reserve is tightening, it has shot up, but it has trouble going above 3%. It was above 3% for just a couple of days, and I chose that 3% threshold because I know the pressure needed to make this yield stay above 3% is exponential. Going from 0.58% to 1%, 2% takes very little. Each additional gain gets harder and harder, and remember, if this stays above 3% for very long, the entire US real estate market will crash very substantially, which is why market forces are not letting this rise too much. However, the Federal Reserve will have to stop tightening and resume money printing pretty soon to prevent this from exerting too much pressure on home prices, or at least obstructing a soft landing and instead generating a pretty volatile crash. So 2.88%. So we go back to the scorecard. So we saw all three: US CPI, Goldman Sachs Commodity Index, and 10-year US Treasury yield. What are they? 2.5% as we saw, negative minus 0.03% in the case of the Goldman Sachs Commodity Index, practically zero, but technically in deflation, and 2.88% for the 10-year US Treasury yield. And I look at this every month, sometimes twice a month. You can look through the archive of videos to see the trend over here, and it is just not rising. There is not a structural inflation problem, even if there is short-term inflation, as we saw in the CPI. The most important of these three is the Goldman Sachs Commodity Index, as I say again. But all three in combination are what's important, because this is a holistic, multidimensional, international, and unriggable assessment of inflation. No one can say, oh, inflation stats are rigged. These things are freely traded and worldwide. So here we are with the latest data. Now, I hope you found this video to be informative. And if you're new to this channel, that you have learned how to look up this type of data in a way that tunes out all the garbage narratives from the media. Because the media has a vested interest in making you frightened and has decided that inflation is what is needed to make someone frightened, when in fact that is not accurate at all. Deflation would be much scarier than inflation. So if you like this type of content and you would like to see more videos like this be produced, then I encourage you to subscribe to this channel, and thank you very much for watching.